Hey guys, hope you had a great summer. This is Ben, and I wanted to talk about a couple of ideas that I've been thinking about, steering away from the classic setups we do with long-short spreads. Now, first, let's have a quick look at what's been going on, just on a broader picture. So the overall market has recently rebounded from the pullbacks we experienced beginning of August. It was actually more of a correction in like semiconductors. They had a SMH semiconductor ETF falling about 30%, okay, before buyers stepped back into it. In the meantime, there's been a rotation, really, or shift, okay, from these lofty valuation plays with high beta and high risk into more defensive areas. Well, the markets, especially companies with strong fundamentals, solid balance sheets, and lower valuations. The economy is still hanging in there. We've seen some sign of weakness, but nothing too crazy. Inflation seems to be under control. We just had a PCE price index this past week, which is pretty much unchanged. However, we do need a catalyst, okay, to get things moving. And I think the market could probably just grind sideways going into the election, because that would be a major catalyst. But in the meantime, we also had the FOMC coming out in a couple of weeks, talking about interest rates, which, yeah, they're probably going to cut. Question is how much and what are they going to do going forward? So that's probably going to shake things up as well. But this is what I call a stock picker's market, guys, where there are a ton of opportunities, but you got to know where to look. So I'm going to talk about two ideas that both fit under the umbrella of what we call tail risk trades, which really just means trades that have a high chance of making larger than normal returns, or basically moving much further than was expected in other stocks. And they tend to be in lower price stocks with a higher options implied vol, which we're seeing in the one I'm going to talk about now and the next one also. So the first one is Beyond Meat. Okay, so here's the chart. You can see just absolutely no sign of rebounding. Ticker is BY and D. Also note the kind of 2 to 4 point range the stock has been over the past year, but with progressively lower highs and lower lows, which from a technical standpoint is no bueno. And most of you probably know they make plant-based meats, which kind of sounds like an oxymoron to me. So for the purpose of this trade idea, I actually bought a Beyond Meat patty to make a burger. And pretty hard to explain the taste, but yeah, it's just not good. Okay, so look, if you don't want animal meat, whatever, that's fine, but just stick to eating veggies because this stuff is beyond gross. Well, that's my opinion at least. Now, clearly, just because it tastes bad does not necessarily make the stock a bad investment. But the company reported earnings about a month ago, and they're just continuing to lose money. So they're bleeding money and also missed expectations. And even though top line revenue actually beats by 4.8 million, the forward-looking consensus estimates just did not improve at all. You can see that on this chart, just not a pretty picture. So the price to sales, okay, on both forward-looking and trailing basis is around a little bit over 1.2. And that by itself isn't really that bad. It's not that high. But it is for a company that is constantly losing money with negative forward-looking growth prospects. So that said, growth, or in this case, a lack of, is not even the main problem here. Okay, so let's have a look at the balance sheet. And on the surface, it doesn't necessarily look that bad with a current ratio. So if you just look at the ratios, okay, like a lot of people do without actually looking under the hood, you'll see that it has a current ratio of 3.8 and a quick ratio of a little over 2, which means that they have more short-term assets versus short-term debts to meet obligations. So yeah, you're like, oh yeah, it's not that bad. However, if you look closer under the hood, just check this out. This is a balance sheet, and about half their current assets are tied up in inventory. Okay, and that's just, you just don't move inventory that fast. And the situation has actually been getting a lot worse. Because if you look at the liquid cash, just liquid cash versus short-term liabilities, This is what that looks like on a chart over the past few years. The bottom line here is, guys, that they are running out of money. Like, they're running out of cash versus their obligations. And it just screams bankruptcy. And to make a bad situation worse, they also have over $1 billion worth of principal debts due in a little over 2 years. And at this point, they just have no way to pay. So that's a huge hurdle they're trying to figure out. You probably won't. This is a heavily shorted stock, okay? So that's 40% short interest. It's going to take over 4 days to cover, meaning it's prone to sharp short covering pops, which we have seen happening all year. So this is the reason why it can be pretty tough to short stocks, especially low price stocks like this. And I wouldn't short this stock outright. But the option chain is liquid. And if we just stick with buying puts, we limit the risk by capitalizing on a potential breakdown. So they report earnings on November 8th, which is likely to be catalyst for a big move, as usually is. But unless they get some emergency funding or maybe become like an acquisition target, something like that, I think it could turn into a penny stock or go to zero. Who knows? But since I'm looking at this as a tail risk type of trade where I take less risk, okay, with a chance for abnormally high return, I'm looking at the January 2.5 strike put at 30 cents. They look pretty interesting. There's 14,000 contracts there. And with the stock at 50 cents in January, they'll be worth $2. Okay, so that would be a 6-to-1 reward risk. Not bad, right? Speaking of tail risk type of trades, let's have a look at the long that I'm thinking. Now, Rocket Companies, ticker RKT, they are a digitally focused lending company that streamlined the whole lending process, okay, with their AI-fueled homeowner strategy, as they call it. Now look, I know a lot of firms use AI now kind of as a catchphrase, but with Rocket, 70% of their service calls are now powered by AI. And I know that can be annoying, but it does save the company a ton of money. And it's honestly being the whole auto answer type of service has been getting a lot better for a company that's focused on AI, I must say. So anyway, mortgages make up the vast majority of their business, but they also provide other loans, cars and personal loans, things like that. And in the last quarter, they beat on both top and bottom line numbers and reported a 25% growth in revenue. And so the wholesale market has been sluggish, hasn't really gone anywhere. But these guys actually did pretty well, even in the face of that. And with multiple rate cuts potentially around the corner, it really could get this market back in gear. They report beginning of November, and I think there's a pretty strong chance they're going to surprise to the upside. And then we have, right after that, we had the usual election, obviously, it could get things moving. So this would be another tail risk / pain trade type of scenario where we need a stock to have a pretty significant move to make some serious money. The stock made a high of 40.88 in March of 2021. And yeah, it's probably going to be a while before it gets back up to new all-time highs. Anything can happen with a kind of fast-growing fintech company like this. Here at ITPM, our bread and butter trades tend to be various option structures, okay, where we are long and short the same type of option. Okay, so it'll be long and short calls for different expirations. And we do that to harvest time decay, hedge out exposure, and along the way, kind of picking up credits and maintaining significant upside potential. However, like with BYND, these are both tail risk type trades. Okay, we expect larger than normal moves, which is also why the implied volatility for these options are much higher than normal. So just buying the January 30 calls for 40 cents will be a 12-to-1 reward risk if the stock is at 35 in January. So let's just put that in perspective. Let's say you normally allocate about $5,000, right, per trade for a $100,000 account for our typical option legs. For this one, you spend less than half. Okay, so about $2,000, which means you're buying 50 contracts. And with the stock at 35 at expiration in January, you're going to have a P&L of $23,000. So that's 23% on the whole portfolio. Okay, we have a $100,000 portfolio by allocating and risking only 2%. That's what we mean by tail risk trades. Now, I know we're asking quite a bit of these plays, but let's say can't get to 35, right? So remember, we're long to 30 calls, and after earnings in November, the stock gets to 30 and just kind of stalls out there. And you think, well, we had the 30 strike call, stock's at 30, boo-hoo, we're losing. Not really, because this is such a high implied vol stock, and they also maintain their time value a lot better. So they're actually still going to be worth 2.9 in time value at that point. And I'm going to show you how to calculate that during mentoring, okay, because it is a bit tricky. But with the stock at strike price following earnings in November, so let's say stock is at $30 following earnings in November, you don't see any more upside really at this point. You still make over about 12 grand, okay? So beautiful thing about this one is that profit potential is unlimited because it's a call option. Stock could go up, who knows? There's no limit how far stock can go up. And the risk is only 40 cents per contract. So if this one really launches, it will be a sweet play. Anyway, next time, later.